I know. You're waiting for a video on the perfect strategy, right? Well, we're going to get there. But the first thing I want to talk about is something that is even more important, and that's position sizing and just how important it is. And so that's what we're talking about today. The importance of position sizing. There it is. Here's the deal. Most traders, and that probably means I'm talking right to you because you are most traders. They're looking for entry points into the market. They want to know about a strategy or a method that has been back-tested and gives them a perceived edge. And that's great. Really, it is. Look for a strategy that, supposedly works. And it's got data to back it up. However, what they usually skimp on once they find this fantastic strategy is how are they going to manage their risk? They might think, well, because the strategy has stops or some well-defined exits, that they're all set. No problem. Now, this couldn't be further from the truth. And that's because the number one thing that will determine their success is not the stop. It's not the amount of risk that they take per trade, where they say, oh, it's a one-time risk for two-time reward. No. The number one thing that will determine their success is their position size. And traders completely overlook this. Or they think that it doesn't matter. But it does. It matters a whole lot. And I'm going to demonstrate that. So let's take the tale of three traders. We have the small, medium, and large trader, the timid trader, the aggressive trader, and then the trader that wants to swing for the fences. They're all given this same strategy, the same automated trading strategy. They don't have to do anything. All they have to do is pick their position size. And each of them get $10,000. And the only variable, like I said, is selecting what position size they want to use. Now, the strategy has the following performance characteristics. What I'm going to do is I created this spreadsheet that actually generates 500 trades, and we can mold what the kind of performance characteristics that we want. Pretty cool. So here's this thing. Up in the upper left-hand corner, this strategy is going to have a win rate of 50%. You might say, 50%, what good is that? It's a coin flip. However, the average winner is twice as big as the average loser. And anybody that knows anything about trading knows that this is an edge. And of course, I'm going to include slippage of 15%, and that's normal. Most people just totally blow that away. They don't look at slippage or commission, and they'll look at a strategy and they'll say a beautiful trading curve, and they'll just think, who cares about commissions and slippage? But it does. It makes a commission and slippage, once you introduce them into most strategies and most back-tested results, because most people will not tell you about them, but as soon as you introduce them, totally blows away the strategy. So we have a winning strategy for sure, on average. That's the key. It has big winners and relatively small losers. The losers are half the size on average of the winners, where the average winner is 100 points and the average loser is 50 points. And then the other thing that I can define is, well, what kind of range do these things have? And I'm going to even make the range of the winners pretty big so that it can be all over the place and it gives it real chance to grow, while losers are relatively contained. We might have this fantastic exit strategy, that really contains risk and you can feel so good about it. So then we come down to position size. Like I said, the first trader, they're timid. They don't trust anything. They're going to put in the minimal amount of a position size for each trade and never vary from it, and we'll call that 5 units. The second trader is way more aggressive. They said, look, I think that this thing is a winner, and so I'm going to double up. I'm going to put in 10 units for each trade. The third trader, he says, for Christ's sakes, this strategy is a winner, man. let's just go for the fence, hit for the wall, go for the wall. So what he's going to do is he's going to employ a strategy that isn't fixed, that is based, because he heard that, hey, make it based on your current capital, because that's the most efficient way to grow your account. All right, cool. Well, let's take a look at the results. As you can see, the fixed size traders both did pretty good, and the guy who managed to, or decided that he was going to take twice as much risk, really did good. And these are 500 trades that actually get traded here. Now, the person who's swinging for the fence, now this is for this, I want to emphasize, this is for this instance of data. Every time I change the data results, in other words, I randomly generate them, I get different results, and they are usually pretty much the same picture. But check out what happened to the guy very early on that was swinging for the fences. At first, his profits jumped way up here, up to $33,000, while these other guys were sitting around with about, that would be $23,000 of profit because we started with 10, while these other guys are out there with pretty good profits after about 100 trades, but nowhere near what he has. And then all of a sudden, he just loses it. He's overdoing it on the position size, and it drops down. But he recovers and drops down, recovers again, and still staying way ahead, giving the promise that, man, if I can just catch a groove, this thing will take off. And eventually, it just dies. We can take a look at that trader's performance. And we can see that after just the 11th trade, they were up to $33,000. And then came all the way down to just $2,600 after a few bad beats. And this is not unusual. Let's try something a little bit different. Let's try a much better system. Let's try one that has 65% average winners, but the volatility is much higher. Let's say the volatility is 90. And even on here, the volatility is really high. All right? Still, a great system, a little bit more volatile. Now we have to go in and generate the data. So we go in, we generate the data, and then paste the values. This is where all the data is drawn from. All right, now we can go back to our main and see what the result is. Well, it's a very similar story. Look at this guy that swings for the fences. What would happen if this person, that instead of swinging for the fences, they went for something less? Let's say they went for 50%. Well, here they avoided breaking their account, but still came back. What happens if we go for, say, 40%? A little bit better. I mean, look, at one time, this guy, all the way up to, made $250,000 after about 290 trades. Well, let's go down even further. Let's go to 10%. Holy crap. Actually making more than the person that's trading 10% flat, but with a great deal of volatility. What if they went down to 8%? Wow. So here, I am demonstrating, I'm going to go down to 6%. Wow. Here, we're taking 6% of the total capital as our position size. We're putting less on the line, at least initially, than the trader number 2 at 10. But we quickly will rise up above that. As you can see, we'll take a look at that data. See, we start out at a position size of 6, grows to 10, and then takes off from there. And then catches a groove. So here, same strategy, same results in terms of when they get in, when they get out, but markedly different actual results or returns. The profit and loss is dramatic. Swinging for the fences doesn't do that much good. Let's see what happens if we swing for the fences with this guy. Let's say he decides to go for, 80. Actually does okay. But see, that's for this particular set of results. I could put in a different set of results, and this person could also blow up the account, trader number 2. But trader number 3, with very little risk, comparatively, was able to make a lot more money by trading small. So we can see here that trading small and maybe a more progressive position sizing strategy that's relative to your capital size is probably the most or the best way, or it gives you the best opportunity to profit. But it also gives you a great deal of volatility. So there is an illustration of why position sizing is so important. Same strategy, different positions that we take, dramatically different results. Hope this makes sense to you.